Hi folks, welcome to this video on long-term notes receivable. You remember with long-term notes receivable, whether they're interest or non-interest bearing, all of the interest receivable is included in the value of the note receivable itself. You'll also remember that for our course, we are going to use the effective interest method to amortize any interest revenue into the note. Now, in our case here, we see we have an interest-bearing note because this note is bearing interest at 4%. The market rate for the note is 6.5%. In this case, on December 31st, 2009, Myra loaned Zarko some money, and in exchange they want a payment of $200,000 back at the end of a 4-year period. So because the note is interest-bearing, we are going to use the coupon or the stated rate in order to help us calculate the amount of interest that Zarko will pay Myra each and every year for the next 4 years, and that turns out to be $8,000 a year. In addition, Zarko has to pay Myra back $200,000. But in order for Myra to make the journal entry on its books at the date the note is made, which is December 31st, 2009, we need to calculate the present value of the note. Remember that the effective interest method presupposes that our note will be recorded at its present value, and we will use the present value of the note at the beginning of each period in order to calculate interest revenue for that period. So now, let's use that $8,000 as our payment in order to calculate the present value of the note. So now we know the future value, or the amount that Zarko pays back to Myra at the end of the 4-year period, is $200,000. We know the note is for 4 years. We know the interest payment, or the interest rate per year, or the market rate or yield, is 6.5%. We calculated our payment down here. So now to compute our present value, we have $182,871. So therefore, when Myra records the note, it does so by debiting the note receivable for $182,871, which is the present value of the note at December 31st, 2009, and credits cash. Now, in order for Myra to update its accounting records at the end of each year, they need to record interest revenue. We can use an amortization table in order to help us calculate the interest revenue that Myra will book each year. Now, you'll notice in this table, I've begun with the period, that's the issue period December 31st, 2009. That's actually the issue date. So I guess I could have put in here issue date, which is the same thing as December 31st, 2009. And the note is being carried at a value of its present value, which is $182,871, as we determined up here when we calculated the present value. Note that what I didn't do in this question, in this part of it anyway, is I didn't include an unamortized discount column. If you prefer, you'll notice down here at the very bottom of the question, I did produce the table here to show you an alternative balance sheet presentation using an unamortized discount. But for now, let's proceed with the amortized discount column only. What we see here is we're going to use the carrying value of the note times our 0.065 rate, which is 6.5%, in order to calculate the interest revenue for the entire 2010 period. Now don't forget, the carrying value, or the present value of the note at the end of December 2009, is the same as the present value of the note at January 1st, 2010. So we're going to use that opening present value, or carrying value of the note, to calculate interest revenue for the entire 2010 period. So now, carrying that through, we know that in 2010, we're going to get an $8,000 payment from Myra. In addition, from Zarko, we in addition are going to book as Myra $11,887 as interest revenue, and we've calculated that down here. This $11,887 is a number that's rounded to the nearest dollar when you do the exact calculation. So therefore, we have an amortized discount of $3,887, which is the difference between the interest revenue and the cash interest you received. And that's going to give you the carrying value of the note, now equal to $186,758, which is the carrying value of the note to open 2010, i.e. January 1st, 2010, plus the amount of discount that got amortized to the note, which is $3,887. So adding this amount here to the carrying value of the note will give us the carrying value of the note at the end of 2010. Don't forget, Myra has to record the note at its present value each period. So every period, that note should get closer to 200,000 because in order for them to close out the note receivable account, they have to accept cash, or they will accept cash at the end of the 4-year period of $200,000, as was indicated in our question. So now, if we go into 2011, we're going to use the same calculation. We will take the present value here, which is 186,758, and we can use that in order to calculate our interest revenue, which is going to be calculated based on our 6.5% interest rate. And if we did that calculation, we would get a number of 12,138. So we can take this 186,758, multiply it by our market rate of 6.5% in order to get interest revenue of $12,139. The difference between that and the $8,000 that we received in cash, that Myra received in cash from Zarco, which is $8,000, is going to give us an amortized discount on the note of $4,139. So that now brings the note up to $190,897. If we do this calculation for the remaining 2 periods based on the present value of the note to open, in this case, 2012, multiplied by 6.5%, we're going to get $12,408. Calculating the amount of the discount amortized is the difference between this interest revenue and the cash that we received as Myra from Zarco. We're now going to have a carrying value for the note of $195,305. Therefore, in the last period, we're going to use this $195,305 to help us calculate interest revenue by multiplying it by 6.5%, and that will give us interest revenue for our last period of $12,695. The difference between that and the cash interest that we received from Zarco is going to mean we're going to amortize our discount or we have an amortized discount on the note of $4,695. Therefore, so you can see here we have an amortized discount on the note of $46.95 added to our most recent carrying value will bring us to $200,000. So therefore, now we've prepared our schedule, which is going to help us to prepare our journal entries. So now, if we go down to December 31st, we want to make all the journal entries here at the end of each year to record our interest revenue and to collect the note. So each year we will get cash of $8,000. Our note receivable will be increased. I guess this isn't there. Now it's better. Debited in 2010 by $38.87, and our interest revenue is increased by crediting it $11,887. Notice that each year that we record our debit to the note receivable, bear in mind that our note receivable is now, with every debit to it each year, climbing closer to the $200,000 value, which we're going to use to discharge the note. Okay, so now if we have to prepare a balance sheet at the end of 2011, we can see that because the note matures at the end of 2013, in 2011, we can see here, I'll just highlight the whole row here. Whoop. There it sticks now. So now, at the end of 2011, we should be showing our note at its carrying value of $190,897, and because the note doesn't mature until the end of 2013, we would show this as part of the non-current assets. You could alternatively just show it, and instead of this, you could also just say long-term investments. All right, because it is a long-term investment, that is a non-current asset. And we're going to show it at its carrying value of $190,897, which we got from here in this table. Now, if you chose, when you did your table, to show an unamortized discount column, as I did here, you could show the note as a non-current asset or a long-term investment as notes receivable $200,000, and here you would show an unamortized discount in that period of $91.03. Now, if you're concerned about, or I just finished this off now, the note receivable then would show it at its same carrying value as it did up here of $190,897. Now, if you're confused a bit on how we get these numbers, think of it this way. When we issued the note, we gave out cash of $182,871, but we expect to be paid $200,000 back at the end of year 4, or 2013, which is the end of the 4-year period. What that means is the difference between the $200,000 that we expect to get at the end of the 4th year, which ends December 31st, 2013, and the amount of cash that we loaned out. The difference is the amount of discount that's unamortized. So in essence, the carrying value of the note plus any unamortized discount is going to give us the note at its face value. So therefore, what do? Here what we would do is we would show the note at $200,000 less the unamortized discount to show it at its carrying value of $190,897. So you may recall this is a similar concept to that which we did with bonds. All right, in your previous course when you studied bond liabilities. So if you choose to use the unamortized discount column, you can certainly show it this way if you wish. All right, so that concludes our presentation on Myra and Zarko with a long-term interest-bearing note.